my presentations will be focused on the financial aspects and what this means to business owners, small business owners. So when this bill got put into place, a lot came out of it. We could all agree on, whether you're left, right, either side of the aisle, is that it's big. There's about 1,000 pages worth of bill to this. So a lot of legalese, a lot of things to comb through. And we were tasked as an industry to kind of go through this and see where all the pros and cons are that could impact our clients. And it wasn't easy. So collectively as a profession, there's like 50, 60 bullet points on things that could impact business owners, personal planning, so on and so forth. And we were tasked to see what was actually relevant. So for the purposes of this presentation, I put together about 10 things that could be takeaways for small business owners and some things that are cons. So whenever there's a change, and this bill is a change, but whenever there's a change to law, there's opportunities and there's pitfalls, pros and cons. So that all being said, my presentation went away. But next slide. Okay, well, I'm going to get right into it. One of the biggest things about this bill that was a pro for everybody out there, was a very hot subject item, was the income tax, the federal income tax rates. So federal income tax rates right now are historically low. The top tiered tax bracket is 37%. Historically speaking, that's extremely low. And you have to have a combined household income if you're married, filing jointly. I can't even see it. 752. Yeah. It's a lot of exposed taxable income. So most people don't pay that. The tax bracket is usually around 10 to 35%. And that's over 99% of the population that's paying that tax bracket. It's low. You look over the past 120 years, Jeff could probably speak to this a little bit more clearly. It's about as low as it's ever been. So that being said, we're programmed to try to get our taxes as low as possible, pay the IRS as low as possible, but because of where we are, one of the strategies that we've been implementing is maybe paying yourself more, put more on the books. And because of some of these loopholes, you might actually save more money because you're paying yourself more if you're doing it effectively. So the next highlight I'm going to roll into is leveraging the standard deduction. All right, so the standard deduction is as high as it's ever been as well. So a married couple, the standard deduction is $30,000, $15,000 per person. But where I'm going to touch base on this is if you have, like, say, dependents that you're putting on your tax returns. So, if you have dependents, you have children, or maybe you're, taking care of an ailing parent or aging parent, or maybe you have a sibling with disabilities, you claim them as dependents, and you get a little bit of a tax break on that. But anybody filing the taxes, especially small business owners, know it's not much. It rarely makes a flip. So, different strategy. With this big, beautiful bill, here's something you do. Put your kids on the payroll. Put your aging parent on a payroll. Anybody that files a tax return gets exposed to this standard deduction of $15,000. It's all in the same household. So let's play out the scenario. So you're a business owner, married, you have 3 children, and maybe you're taking care of a parent. All right, you're claiming 4 dependents. Well, if you have a role within your company, like let's say house cleaning or web design or whatever, marketing, you put them on the payroll and they file a tax return, that's $15,000 of standard deduction. So 3 kids, $15,000 apiece, $45,000 worth of deduction. Parent, another $15,000. Married couple, that's $90,000 in deductions you didn't have before. And a dependent deduction with a child credit, it's like $1,600. It's just, you could do a whole heck of a lot more now with the standard deduction that you couldn't do before. That actually leads me into my next piece, which is income shifting strategies. So I just refer to income shifting. That's using your dependents and putting it on the payroll. Another strategy is using trusts. So trusts are legal documentation. I'm not an attorney. I don't have an attorney with me. I don't want to get into too many details because that's not my field. But we leverage trust the same way of diverting money from the payroll or into your pockets, I should say, and not into the IRS's hands. All right. Next thing I'm going to get into is accelerated depreciation. All right. So Jeff talked about this. The accelerated depreciation, there's a 100% bonus. The limit was was $1 million before this big beautiful bill. That's been up to 2.5 mil. So we all know cost of goods. We all know there's depreciation to it. That limit went up to 2.5 million. And there's actually a phase-out stage too. So you could write off up to $4 million worth of depreciation. And there's you don't get the full 100% bonus, but you will be able to write off $4 million worth of depreciation. Now starting, the look-back period, as far as I know it, is January 20th, 2025, when the administration changed. But anything you bought after that date, it was $2.5 million. Next thing I'm going to touch on is research and development, another thing Jeff was talking about. Research and development. We know how anybody that's in a business where research and development falls into your mix knows that whatever you spend for research and development, you have to amortize over a 5-year period. One thing I've also noticed just by talking with clients for the first time is maybe they're in a business they didn't know they were using for research and development, so maybe a little bit of reclassification or a look back on your taxes could help, but still, it's over a 5-year period, or was. Now, because of the law change, you could write off all that research and development within the very first year. So I believe the rebate's like 7 to 12% or so, depending on your field, but you could get that all in the very first year. So play out a scenario. Let's say you spent $1 million worth of research in a given year, and you want to write all that off. Well, let's say the credit is 12%. That's $120,000 that you get back, but you have to get it over a 5-year period. Now you get it the first year. And as a double bonus, in this bill, any research and development you use as a business from 2022 to 2024, you could recapture all that amortization that you had to plan out over the next 5 years all at once. All right, so any research and development, let's play the same scenario. Let's say it was $120,000 per year. What's that, $24,000 or so? All right, you can recapture all that extra money this very tax year. So it's highly encouraged you go to your team, you go to your CPA, financial advisor, whatever, to see if this applies first, but second, to get this rebate. You might have to do a refiling, but it's a lot of money that's on the table that you can recapture all at once. That's going to, on the next slide. Okay, leads me into the next subject, which is retirement plans. So this is something I deal with directly. These are your 401ks, simple IRAs, SEPs, and there's a lot of different other ones too, like cash balance, but we're, in a nutshell, as business owners, we kind of know, depending on the product, the most you could write off through retirement plans is about $70,000 per person. That's not entirely true. There's defined benefit plans that we put in place that will allow you to write off $280,000 per person. So married couple, $560,000. The reason they're not used too often is because they're really tough to put together, qualify for, and then maintain. These things get red flagged more than anything else. So this is something that I've been doing for years, but I can tell you, just out in the field, it's very hard before this big, beautiful bill to have businesses qualified for this type of plan and this type of deduction. Not so much anymore. Okay, so this is a huge plus in our world, which is going to lead me to the next one, which is the Qualified Business Income Deduction, or QBIC. So depending on how you set up your business, it usually has to go as a flow through, like an S corp or a partnership, but you have an exemption where you could essentially exclude 20% of your taxes at max, depending on your field. Some fields are 10%, some fields are 0%. But now this QBIC is going to stay permanently. This was on the table to be completely removed from the tax code. Okay, it was a hot subject issue. Figure, let's say you're paying $250,000 a year in taxes. 20% off the book, that's $50,000 in your pocket just because you qualify through your business. Taking that away from people wasn't very popular, but now they made it permanent. I'm going to quote permanent because legislation can make that not permanent very fast, but it's here to stay for a little while. So next subject was incentives for family-owned businesses. So I mentioned one of them with the standard deduction. Well, what I'm going to talk about is succession planning or selling your business. Selling your business when it's a closely held family business, there are loopholes now, and Jeff was actually talking about my next subject too, that you can use stocks for the transfer and get a huge rebate on the gains. So this doesn't really apply if you're 25, 30 years old, you're probably going to run your business for another 30, 40 years. But if you're in that stage, 40s, 50s, you're thinking of selling out, you have a partner you might want to sell your business to, this is something to act on. What it really entails is, next slide, please. is this qualified small business stock, USPS. Okay? Right now, the exemption for your stock sale depends on how long you've actually had the stock in place, but there's long-term gains, short-term gains based on your business. But this is an exemption for $10 million for long-term gains. It's just been bumped up to $15 million. Okay? What you have to do to prove this and to get this exemption is first have a value of your company initially, and then show the gains on the company appreciating over time. So if you don't have a business valuation done, well, you're not going to be able to see how much you've actually gained. There's no basis at zero. It starts from when you first do your business valuation. Let's say your business now is valued at $1 million, and in 8 years you sell, and now it's valued at $20 million. If you incorporate in a way, it can't be done with LLCs. It has to be done with some sort of corporation where there's actually stock of a company, and depending on the type of business, sometimes this absolutely will not apply. It won't apply in my industry, right? But it applies in a lot of different industries. But let's say you sell that business for $20 million. Well, there's a long-term gain of about $19 million there. You just exempted $15 million from any taxes. You have to pay on the other $4 million, but $15 million completely exempt. You just have to get it set up correctly where you start with a business valuation, and we do complimentary business valuations. A lot of firms will do business valuations. A lot of them are CPA-based or accountants or actuaries that do this, but once you have that basis, now you can see what your value is, appreciate it over time, and hopefully apply for this exemption. It's huge. All right, which leads me to my last point, which is what we do as a firm is complimentary reviews. We'll see where you stand, but also one thing I want to leave you with is look at your effective tax rate as a business owner. If you're paying over 20% in terms of your effective tax rate, you're probably leaving something on the table. That seems to be like the number, the Goldilocks number that as an industry, we all know of like, okay, well, if your effective tax rate is above this, then maybe if we comb through, we could find something you're missing out on. So I'm going to get to a couple of challenges to look out for. Right? First is we're going to lose personal exemptions and also some miscellaneous deductions like financial advisory fees, fees that I charge, they're not tax deductible anymore. CPA fees, not tax deductible. There's some other ones on there too, and I could list them all out. But the other thing that's big for business owners is personal exemptions. So as business owners, myself included, whatever you pay for gas, you pay for lunches, you write all that off. And up until this big, beautiful bill, it didn't matter how you categorized whether it's a business expense, a personal expense. You just wrote it off. All right, and there was nothing really stopping you from doing that. Now you got to categorize. All those expenses you have to put as a business expense. So moving forward, it's important that you will have this prepared so you can actually get these deductions taken off your books, get that money back in your pocket. Okay, it's going to be a hassle. We're going to have to be conditioned to do this. It's going to be an ongoing thing moving forward, but this absolutely applies now. Next slide. All right, it also compliance complexity. When I say compliance, I'm talking about the IRS. So all these exemptions are here in place for us to use for tax avoidance. It's not a bad term. It's where the loopholes are. They put it into code for a reason for you to use them as small business owners, but you have to do it correctly unless you want to see red flags come up. And when red flags come up, that leads you to an audit, and audits are messy. Probably from my end of it, when I'm talking to a small business owner and I get something coming in where we have tax problems, a lot of times the tax problems and taxes that are back taxes or taxes due are not because this business owners did not pay taxes. It's because something went wrong with how they file. Either their advisor or their CPA just didn't do it the right way. It became a mess. The IRS found out, and guess what? They got a problem. All right, so it's important to get ahead of these things and to do it the right way. So a couple of action items or take-homes, if you will. First one, check your effective tax rate. If it's over 20%, find a professional, deal with your team. If you have CPAs, financial advisors in place, go to them, go through your taxes to see if there's anything that's missing regarding the big, beautiful bill that's new, that you might not have been aware of. We could get some of that money back. Next is to explore family payroll options. All right, so I mentioned the standard deduction. There's trust that could be used for leverage with this, but yeah, trying to get as much money out as possible. When I was saying pay yourself more, pay your kids more, pay your family more, get bigger deductions, it's there in the code, and you can use it. Next is upgrading your retirement plan offerings. All right, so, depending on whether you have a retirement plan, you may not, may be using one, but check it out. This could be a good way to stash money. It's one of two things. Either you pay yourself or you pay the IRS. It's a matter of which one do you want to do. Lastly, reclassify expenses. So this is something that is going to be, moving forward, something we're all going to have to be conditioned as small business owners to reclassify everything we do as a business expense to get these expenses, but start now. Okay? And start immediately. When it comes tax season next year, if you haven't done this, I'm sure there's going to be some lookbacks that we can do. We're not being told we can right now, but I'm sure it's one of those gray areas that nobody knows as to be law. But start now. Start reclassifying everything you're doing and put it as a business expense.